bond market has reacted to two significant events last week: a national election and the Federal Reserve rate cut. Historically, elections tend to drive volatility as investor sentiment can shift drastically based on the perceived policy direction of the incoming leadership. This past election was no exception, with bond yields responding to both pre-election uncertainty and ongoing policy speculation. Adding to this, the Federal Reserve's decision to cut rate further by 25 basis points, bringing the entire rate to 75 basis points since September. Meanwhile, inflation remains a key focus. Although latest readings showed a month-to-month increase, which was dismissed by the Fed and the market alike. However, the same reading offered more promising long-term view. Most notably, it suggests inflation is nearing the Fed's target of 2%. While housing-related costs remain elevated, the non-housing portion, accounting for about 80% of the metric, has already achieved this benchmark, signaling that inflation may indeed be stabilizing in line with policy goals. In the press conference following the rate cut decision, we heard the chairman say, even with today's cut, policy is still restrictive. Also, we heard, as we approach a neutral rate, may be appropriate to slow pace of cuts. Also, we heard that we are watching long-term yield, and it does not seem about higher interest expectations. All of that make us believe that there is a clear change of tone by the Fed, underscoring their commitment to keeping inflation in check, while acknowledging that current rates remain high enough to temper economic growth and likely to be brought down by further cuts. The bond market reacted with mixed signals as investors weighed the potential for a future rate cut against the likelihood that high rates could persist. Therefore, sensitivity to every Fed move to be expected, with each decision carrying implications for both short-term yields and long-term stability. Finally, the upcoming inflation data releases for October, November, and December might make inflation look more stubborn than it really is. This is due to base effect. That's the measurement between this year and last year's inflation data, starting at a lower point.